Today, let's talk about the commercial toolmaker Snap-on. When they recently announced a 15.4% dividend increase, it got my attention. When I took a closer look and learned that the raise actually was right in line with Snap-on's annual dividend hikes of the past decade, my interest was really piqued. We're talking about a company that has paid a dividend every quarter without reduction or interruption since 1939. And then, when my research led me to discover a high-quality company that's been in business for more than a century, a well-run operation whose products will be in even greater demand during the upcoming infrastructure boom, and even a company whose stock is fairly valued, I knew Snap-on was a stock I wanted to seriously consider for our income builder portfolio. Hi everybody, Mike Nadell here for the Dividends and Income channel. Before I get going, please do us a favor to help us grow our channel, okay? Hit the thumbs up at the bottom of the video, subscribe to our channel, and ring the bell so you get notifications of new videos as we publish them. Okay, now let's talk about what makes Snap-on tick, how it might appeal to dividend growth investors, and why I felt it was a good addition to the IBP. In 1920, as the automobile was becoming recognized as the future of American transportation, there was a growing need to make tools to fix cars, and Milwaukee engineer Joseph Johnson created a wrench set with 5 handles and 10 sockets that could be interchanged quickly and easily. Operating under the credo 5 do the work of 50, Johnson and his business partner used demo sets and brochures to secure orders for 500 socket sets, and Snap-on Wrench Company was born. They opened a manufacturing facility in Milwaukee, they launched an advertising campaign, they secured their first patent for an item they called Number 6 Ratchet, and they worked to expand the company's reach. By 1925, there were 17 branches and 165 salesmen selling Snap-on hand tools directly to mechanics. International expansion began in Canada. In 1929, the company moved its operations to Kenosha, Wisconsin, and its headquarters are still there to this day. Innovation came quickly. The company developed toolkits unique to specific car model, and then they also branched out into heavier duty socket lines for working on trucks, airplanes, farm equipment, road machinery, mills, mines, and power plants. During the Great Depression, when money was tight, Snap-on became the first tool company to let its industrial clients use credit. Snap-on became a preferred provider to the U.S. government and was heavily involved in the World War II effort. The military upgraded the material specifications, with nickel alloy steel ultimately becoming a Snap-on standard. In the decades after the war, Snap-on continued to innovate and expand. There were wheel alignment products for cars, a new railroad division, salesmen taking tools directly to smaller customers, aerospace products, and expansion into Central and South America. As air travel boomed, reducing weight became essential. The Navy asked Snap-on to help develop tools that could handle lighter, stronger fasteners. The result was the flank drive wrenching system, which quickly proved so popular that it spread throughout the entire product line. The company built new and larger factories in the 1970s and 80s and created a manufacturing breakthrough called cold forming that made sockets stronger and more specialized. In February 1978, Snap-on began trading on the New York Stock Exchange under the ticker SNA. The sky literally was not the limit for Snap-on, which developed equipment for NASA to service its lunar rover, space shuttle, and space station projects. In more recent decades, Snap-on went on an acquisition spree to bring more brands under its umbrella, established relationships with auto racing and other sports, expanded into Australia and Japan, partnered with schools for aspiring mechanics, and increased the size of its credit operation. Although Snap-on continues to emphasize tools for auto repair and maintenance, tools that are mostly distributed by franchisees through well-stocked vans that travel to technicians' places of business, the company's reach is broad and multifaceted. Snap-on operates through 4 segments: commercial and industrial, Snap-on tools, repair systems and information, and financial services. Snap-on offers wrenches, sockets, ratchet wrenches, pliers, screwdriver, punches and chisels, saws and cutting tools, pruning tools, torque measuring instruments, power tools, tool chests, roll cabinets, diagnostic products, service and repair information products, diagnostic software solutions, electronic parts catalogs, business management systems, point-of-sale systems, integrated systems for vehicle service shops, and warranty management systems and analytics. For auto shops, the company offers wheel alignment equipment, wheel balancers, tire changers, vehicle lifts, test change equipment, collision repair equipment, air conditioning service equipment, brake service equipment, fluid exchange equipment, transmission troubleshooting equipment, safety testing equipment, battery chargers, and hoists. Snap-on also has its hands in the aviation, aerospace, agriculture, construction, military, mining, natural resources, and power generation. You see, this is a company whose tools are used in a lot of industries. So now that we know a little about Snap-on's history and its business operations, let's talk about its financial picture. Like so many companies, Snap-on was hurt by the sudden impact of the COVID-19 pandemic in early 2020. But the business has rebounded strongly, and its balance sheet couldn't have received a much better financial sonar picture from Jefferson Research. Earnings quality, strongest. Cash flow quality, strongest. Operating efficiency, strong. Balance sheet, strongest. Valuation, low risk. Snap-on reported its third quarter 2021 earnings on October 21st, and the results easily beat estimates. The company experienced significant year-over-year growth in sales, earnings, and profit margin. You name the metric, and Snap-on has excelled. Earnings per share have risen well above the pre-pandemic level, and free cash flow also is very strong. Return on equity, return on invested capital, and operating margin each eclipsed the 20% mark over the last 12 months, and that's nothing new for Snap-on. What's especially nice is that Snap-on has been able to achieve so much growth without taking on much debt at all, and that's a sign of a well-run operation. Snap-on has received a solid A- credit rating from Standard & Poor's and an A+ financial strength grade from Value Line. And Morningstar says Snap-on has significant competitive economic advantages, also known as a moat. Looking ahead, the $1.2 trillion infrastructure bill President Biden is about to sign can only help Snap-on. All that construction equipment will need servicing and repair. Workers will need the best tools to fix bridges, and so on. Even the gradual shift to electric vehicles could be a boon for Snap-on. Morningstar says the company will thrive as auto manufacturers are already tapping the company to develop new tools to service new EV models. They think repair work will shift away from engines to batteries, sensors, wiring, and advanced driver assistance systems. Okay, now let's talk about Snap-on's reliable, ever-growing dividend. Snap-on has beaten the S&P 500 index over the last 10 and 20 years. As this fast graphs illustration shows, a big chunk of the 20-year outperformance is attributable to the dividend. The red circled area shows how Snap-on crushed the S&P 500 even without dividends being included in the calculation, and the yellow highlighted area indicates how much the dividend added to the outperformance, with the end result being an outstanding 11.1 annual rate of return over a 20-year span. There were years the companies didn't raise the dividend, so it isn't a dividend aristocrat, but Snap-on has been aggressively raising its dividend for many years. It's grown more than 300% since 2012 alone. Snap-on declared its most recent 15.4% raise on November 4th, lifting the quarterly payout from $1.23 a share to $1.42. The ex-dividend date is November 18th, so investors must own shares of Snap-on by November 17th to receive the next distribution. This latest dividend increase pushed Snap-on's forward yield to 2.7%. Put that together with the perfect 99 dividend safety score that the company gets from Simply Safe Dividends, and you have a stock that could be very attractive to dividend growth investors seeking consistency and reliability. And with healthy payout ratios, 38% of earnings, and 27% of free cash flow, there's every reason to believe that Snap-on will continue offering generous dividend raises for years to come. The company also has been reducing its share total through buybacks, and a new $500 million share repurchase program has been authorized by the board of directors. Here's what CEO Nick Pinchuk had to say about the dividend and the buyback program. The dividend increase and the new share repurchase program demonstrate our steadfast commitment to create long-term value for our shareholders and our ongoing belief that we're well positioned for the future. This 12th consecutive annual dividend increase confirms the resilience and strength of our business, as evidenced by our payment of consecutive quarterly cash dividends without interruption or reduction since 1939, even during times of substantial turbulence. Our strong financial position and robust cash generation enables both our return of capital to shareholders and our support of ongoing strategic investment, organically and through acquisitions, along our defined runways for growth and improvement. Those are the kind of words that are music to the ears of anybody who does the DGI thing. All right, let's take a look at valuation now. Using FastGraph's forecasting calculator, if I take Snap-on's normal price earnings ratio over the last 10 years and extrapolate it into the future, it suggests a potential 14% annual rate of return through 2023. Forward Equity Research believes Snap-on will outperform the market over the next year or so. They also say the stock is undervalued. CFRA projects a 12-month target price of $246. It also currently values the stock at $241.50 per share, suggesting Snap-on is undervalued by about 14%. Refinitiv compiled numerous analyst projections showing an average 12-month price target of $236. That's about 13% higher than the current price. Other valuation-related data from Refinitiv potential investors might find interesting. Snap-on is trading at a discount to its 5-year average forward PE ratio, in trailing PE ratio, and in PEG ratio. Simply Safe Dividend says Snap-on is undervalued if one compares the company's current current dividend yield of 2.7% to its 5-year average of 2.25%. The PE ratio also is comparably attractive. And finally, Fast Graphs also shows Snap-on to be at least slightly undervalued, as its blended PE ratio of 15 is lower than the 10-year norm of 16. Also of note, Snap-on is expected to grow earnings 25% for the full 2021 fiscal year, followed by 5% in 2022 and 9% in 2023. That's all pretty close to in line with the company's 11.4% annual EPS growth rate over the last decade. After I completed all of my research, I decided to add Snap-on to our income builder portfolio. I was drawn to Snap-on's proven business model, its probability of future success, and of course, its growing, dependable dividend. On Monday, November 8th, it became the IBP's 45th position when I executed purchase orders for about $1,000 worth of Snap-on stock on behalf of this site's co-founder, Greg Patrick. The $1,000 purchased about 4.7 shares, with the average price being about $213.89 per share. It will bring about $26 of income into the portfolio over the next 12 months. If you want to learn more about the Income Builder portfolio, please check out the link in the description. Okay, that's all for today, folks. Again, if you value our content, please give us a thumbs up, subscribe, and ring that notification bell. Take it easy, everybody. Back at you soon.